Good morning and welcome to another edition of our IndexMore series, where we, together with our partners at BlackRock, aim to bring you insights from experts on indexation and much more. My name is Niku Katske, Head of Portfolio Solutions at Satrix, and I will be your moderator today. I am absolutely delighted to welcome our expert panelists from BlackRock today, Laura Cooper, Senior Macro Investment Strategist at BlackRock, as well as Rob Powell, Head of Thematic and Sector Product Strategy at BlackRock. Welcome to you. We are also joined by our very own Kingsley Williams this morning, Chief Investment Officer at Satrix. Now, as always, you are welcome to ask your questions by clicking on the Q&A button at the bottom of your screen. And also just a friendly reminder to stay online for the full duration of the webinar to earn yourself that much-deserved CPD point. Now, what a frighteningly interesting time to be alive. In addition to the current global economic malaise and simmering monetary and fiscal risks, many economies today face the very real prospect of stagflation, not seen since the 1970s. Geopolitical tensions are also at a boiling point, with revisionist powers like Russia, Iran, and North Korea actively confronting the West and threatening the post-World War peacetime we have all come to expect. Now, there's also severe environmental risks debated currently by global leaders as we speak, health risks from pandemics, and of course, technological challenges associated with AI and automation, and the subsequent destruction of jobs that it can entail. There's growing political risks with a broad-based backlash against globalization and a worrying shift towards isolationism from an increasingly polarized electorate, both across developed and emerging markets. In fact, one might argue that leadership reshuffles and distasteful political debates in developed markets make South Africa today seem like a beacon of stability and democracy. Add to all this, historically high corporate and sovereign debt levels and increasingly volatile asset markets truly make it seem like there's nowhere to hide. Yes, not even in cryptocurrencies and much less on crypto exchanges these days. Now, with all this uncertainty abound, investors might be forgiven for being extra cautious in how they allocate their capital. But as we like to say at Satrix, uncertainty breeds opportunity, and one just needs to look carefully. And to quote our fellow panelist today, Kingsley, keep your wits about you. Now, what we aim to do today is to first give you a macroeconomic overview of the year that was, as well as to provide insights on what to expect going forward. We will also discuss how global megatrends have been affected by recent economic and geopolitical tensions, and also how you can use thematic investment funds to add that much-needed risk diversification to your portfolio. Lastly, we will ask our expert panelists to share their views on the ongoing COP27 meetings. But before we go any further with our bumper schedule today, let me hand over the proverbial microphone to you, our expert audience, to give us insights into your thoughts on where you see opportunities in the coming quarter. You should see a pop-up box appear on your screen shortly. Kindly select one of the options, and we will discuss the poll right after. Now, as we are awaiting the results, allow me to welcome our first panelist today, Laura Cooper. She is the Senior Macro Investment Strategist at BlackRock. Welcome to you, Laura.
Great, thank you so much for having me today.
I can see that we have more than half already responded. The results are trickling in, so we can discuss that in a second, Laura. Please make the right decision that best reflects your where you see opportunity in the coming quarter. So I can see, interestingly, Laura, that most of the respondents are choosing emerging market equities, followed by developed market equities. Very few are actually saying investment grade or high yield credit instruments or emerging market debt. So it's interesting that you would think in a world where there's been a sort of a normalization of rates that might be higher, but seemingly our participants are again drawn towards equities more. We've reached 100%. So 31% of you say developed market equities, possibly following quite a substantial correction this year. And then 44% of our respondents say emerging market equities. So that's 75%, 3/4 of our audience is saying equities. The opportunity lies in equities. And only 17% see opportunity in government bonds. Now, let me share the results. There we go. You can see that. So, Laura, as I mentioned in the introduction, it's been a real challenging year for markets, from central banks aggressively raising interest rates to curb inflation, to dramatically escalating geopolitical tensions that caused oil, gas, and food prices to rise, seemingly with no end in sight. Now, before we start looking ahead, I wonder if you can take us back a bit through how you have seen markets perform year to date. Where have you seen bright spots or opportunities, and specifically, what are the industries that have faced the most headwinds?
Well, great. Thanks so much, Nico, for having us today. And I actually must say that I'm not that surprised by the poll results, given that we are starting to see investors turn more positive on emerging market equities as signs of re-risking in this environment. But we can certainly get into more of that later. But maybe just taking a step back and looking at the year that we've seen so far. And as you mentioned, we have seen a number of challenging factors that have really underpinned quite difficult market conditions for investors to navigate. So I think that three notable events stand out. So at the start of the year, we had central banks turn quite aggressive towards inflation that was proving to be more persistent. Then we also had the very unfortunate Russian invasion of Ukraine that spurred this energy shock, and that aggravated already existing COVID-led supply disruptions, and then overlay that with the pandemic restrictions that we have seen in China that is really curtailing broader economic activity there. So importantly, these challenging macro dynamics really fed into asset class performance. And it's quite notable that we have had this simultaneous drawdown of both equities and bonds, the likes that we haven't seen in over 4 decades. And I think this really has raised a key question for investors about, do traditional asset allocations need to be rethought? Do we have to be more nimble in these shifting market conditions? And so I think the predominant narrative so far this year, and continues to be the case, is that central banks are on these aggressive tightening cycles. So we've seen the US Federal Reserve raise rates by about 375 basis points since March. That's almost the most aggressive tightening cycle on record. And we're seeing similar trends come through across advanced economies. Now, as you mentioned, I like the phrase that you used, and this type of uncertainty does bring about investment opportunities. And that certainly has been the case despite this heightened volatility that investors have tried to navigate. So for the first time in over a decade, BlackRock turned underweight developed market equities earlier this year. Now, that was largely because of this sharp withdrawal of accommodative financial conditions, and as well as these expected headwinds on corporate earnings. But we've actually turned positive on credit earlier this year because this higher yield environment has made the asset class more compelling than equities for the first time in over a decade. But importantly, we have seen investors take a more selective approach, trying to find those tactical opportunities in these market conditions. Now, a standout has really been the energy sector. We've seen it perform quite strongly this year because we have seen energy play quite a key role in the inflationary backdrop. But as well, the global rise in energy prices continues to drive this exceptionally strong EPS growth for the sector. And although energy prices have come under pressure more recently, given recessionary risks, we do think there is scope for energy to continue to perform. And as well, the renewed focus on energy security has been a dominant theme in Europe. This has really accelerated the transition to renewables in our view. And then as well, inflation hedges have performed quite well beyond energy. A notable standout is the strength of the US dollar, given the aggressive nature of the Fed tightening cycle that has really benefited dollar-denominated assets. Now, in contrast, where have been the areas of most pressure? Well, certainly what comes to mind is the long duration like equities, notably the tech sector. I mean, we have seen these higher discount rates prompt this sharp decline in the value of future cash flows. So we saw significant multiples compression acting as a drag on overall equity prices this year. So I think overall, taking a step back, it has certainly been quite a challenging, exhausting year to say the least, but I think the dynamics going forward really capture our key investment thesis for 2023, and that is we are entering a new macro regime, one where the old investment playbook may no longer be relevant, and it will really require investors to be more selective and more granular in seeking portfolio allocations.
Thanks. Yeah, it's been an exhausting year, like you said. We are almost in December, so just hang on there. One more month of 2022, and then we'll have a break. It's interesting that you mentioned the long duration assets. If you take it to the infinitely long duration assets, cryptocurrencies, there's also been some pain there. It really does seem like there's very few places to hide, actually. I'm also interested, Laura, in your views on what your expectations are for markets as we head into year end and specifically into an uncertain 2023. You mentioned some of the opportunities and the sectors and industries that have performed as well as taken strain. But how do you view this going into 2023? I mean, it's a very hard question, but what are your broad views on what to expect?
Well, I think it's interesting in the fact that equities have rallied more recently on these expectations that the Fed is getting closer to the end of their tightening cycle. But we think that these hopes will actually be dashed. We do think the Fed is going to continue to embark on these rate hikes. To an extent, they're going to over-tighten and induce a recession in 2023. So that's going to be a key narrative for us next year. And given that the S&P 500 has rallied more than 10% off its October lows, we think that stocks are even further away from pricing in that recession. So there is more downside in equities at this juncture. And as well, if we think about the earnings backdrop, we do think that earnings estimates need to be downgraded further. So just taking stock of what consensus sees right now, they expect about 4% EPS growth next year. We're sitting closer in line with flat earnings growth. So we do think that stocks need to fall on either more good news of easing inflation or just to better price in those recession risks that we do see coming. Because at this point, one in CPI print is not really enough to warrant a trend that would make the Fed more comfortable with easing up on their policy stance. So we remain tactically underweight developed market equities through the year end. But that being said, we do think there are some sectors like energy, financials, and healthcare that really will allow us to take advantage of thematic, structural, and near-term trends. So we had landmark U.S. legislation over the past year, the Inflation Reduction Act, that has really brightened the outlook for renewable energy and the industrial sector. As well, healthcare is a favorite of investors looking for shelter as that recession looms, given that it does have stable cash flows and still relatively attractive valuations. And then we are liking minimum volatility factor and quality companies that should offer equity exposure whilst providing some downside protection. So I think you mentioned this is not an easy call to make about how to allocate funds going into year end and through 2023, but we will be focusing really on what is in the price of assets to gauge when to turn positive on equities. So against this, government bonds are unlikely to act as a ballast of support in portfolios as they have in previous downturns, owing to this new regime marked by higher inflation. So we think investors will still demand higher term premium, higher compensation in order to hide out in this type of fixed income. So overall, looking to 2023, the great moderation of low inflation, low macro volatility has come to an end in our view. So it leaves investors to position for a new regime of greater volatility as the sharper growth and inflation trade-offs really make economic soft landings unlikely. Central banks are likely going to continue to over-tighten to fight inflation. And I think these market dynamics will have important implications for investors. Notably, we expect lower expected returns, greater fee pressure, and it really requires being selective in allocations and taking a more granular approach to your investment exposures.
Fascinating. Thanks, Laura. As always, great insights. Next, I ask Kingsley Williams, CIO at Satrix, to join the discussion. Good morning to you, Kingsley.
Hi, Nico. Thanks for having me.
So Kingsley, with all the global challenges Laura discussed, how do you advise investors that are understandably growing wary of exposing their hard-earned capital to volatile asset markets, particularly with the outlook of 2023, as Laura mentioned, not looking all that rose-colored? So there's still remaining uncertainty. How do you advise investors going into 2023?
Yeah, there's some insights from a Nobel laureate professor I once had the privilege of meeting and even studying under, who basically said that, if you're looking to exit the risky parts of your portfolio after a period of losses, then maybe you shouldn't have been invested in those risky assets in the first place. And I think a lot of that speaks to your investment horizon and making sure that your portfolio is optimally structured for the risk that you're willing to take, and that it's appropriate for that investment horizon. But basically, if you look at risky assets, they are going to require at least 5 to 10 years to pay off, and shouldn't be seen as short-term investments. Over shorter periods, there can be as much as a 1 in 5 chance that you will make an absolute loss, and an even greater probability, say a 1 in 3 chance of not keeping pace with inflation. So losses, in fact, should be expected in the short term when you're investing in risky assets. But what happens as your investment horizon increases, say to 10 years, that probability of loss reduces down to anywhere from 7% all the way down to 0%. So as you give those risky assets time to grow and realize their expected returns, you then find with a much greater degree of confidence that then materializes and delivers those inflation-beating returns. So at Satrix, we subscribe to the view that returns are primarily explained by the exposure that you have to various asset classes. And this is why we focus a lot of our time and energy on optimizing our strategic asset allocations, particularly within our multi-asset balanced funds, and creating different solutions to meet clients' different risk profiles. What we then do is rebalance back to those strategic asset allocations periodically, recognizing that assets which have sold off in the short term and are underweight in the portfolio should, all things being equal, have higher expected returns going forward. Now, this is not in any way to say that additional returns can't be unlocked by trading opportunistically. It's just that trying to time markets is incredibly difficult to get right consistently, and it has as much potential to erode performance in the process as well.
Thanks. Can you perhaps give us an overview of the investment funds available at Satrix that can provide investors with this broad market access that you mentioned? And in particular, discuss how Satrix has a technological advantage compared to other index trackers in making discretionary investing easier.
Yeah, thanks for that, Niku. I'm going to share a slide, if I may, to help explain the point. Hopefully that's coming through.
It's coming through.
And what you'll see with and what the slide is showing are just different indices that we track both locally and globally. And you'll see with our wide range of products, it starts becoming important to have a framework for thinking how those fit together and how to utilize those within a portfolio. So locally, we've got a variety of different broad market equity indices that we track, which offer exposure to the entire investable universe or subsets thereof, like large caps or mid caps, for example. And those are shown on the first branch that I'm showing you now. And then following that, we've also got niche sector exposures or exposures to listed property, which is shown under the second branch. And then the last branch provides exposure to interest-bearing or rates-based assets. And these would typically have lower risk relative to equities and provide excellent diversification to the equity risk that you would incur in those first two branches. In moving further afield, globally, we also track a wide range of different indices which provide developed or emerging market exposure, as well as exposure to select countries, which are interesting for a variety of reasons, and we can unpack that further if time permits. But under the second branch, we've got real assets exposure, where we track global listed infrastructure, and that our research has shown that can provide excellent diversification, especially to the more tech-heavy and growth-dominated indices which you'll find under that first equities branch. And then finally, we also track global interest-bearing, the global investment-grade interest-bearing asset class, which is the Bloomberg Global Aggregate Index that represents that global investment opportunity set from an interest-bearing perspective. And, this obviously hasn't been the greatest of places to be given the rising interest rate environment we've had and rampant inflation. But as those rates have increased, the yields on this asset class are starting to become more interesting. Maybe not yet, because we're not necessarily at the end of the rates-based increase cycle at this stage. But at some point, this asset class is going to provide meaningful yields and once again provide a great means with which to diversify your global equity investments. So I'll just stop sharing that and just address your second point, which is how Satrix has utilized its technology to provide more accessibility to our range of investment strategies. And we've done this primarily through our Satrix Now platform, where investors are able to access both our exchange-traded funds and unit trusts seamlessly. And this allows investors to wrap their investments in more tax-efficient vehicles like tax-free savings accounts, or to save for retirement through a retirement annuity, or simply to make additional investments with complete flexibility to withdraw and access your investments at any stage during your investment journey. But over and above that, Satrix has also pioneered making its ETFs available on what we call list platforms locally in South Africa, and making that accessibility seamless for investors. So investors can buy and sell exposure in an ETF in exactly the same way that they're used to doing with a unit trust fund on those platforms.
So from what you mentioned, it seems that each investor can actually be their own advisor. Can you briefly comment on your views on the need for financial intermediation, given the ease with which Satrix investment funds can be accessed directly? In the past, you've mentioned that we at Satrix very much like to partner with intermediaries and do not want to disenfranchise them. In fact, we see a lot of value. So where do you see the value for financial intermediation, given the ease with which direct investors can access these funds?
Yeah, I often see it as a bit of a journey, Niku, that, when investors are starting out and typically would have a relatively small asset base or capital base that they've invested, often the commercials of financial advice may not make sense at that stage, either for the advisor or for the investor for that matter. So being able to access a wide range of investments easily and cost effectively, such as through our Satrix Now platform, is a great way for investors to build up their asset base through regular and disciplined investing, such as using debit orders. But if the range, what you typically find, though, is that sometimes investors can be overwhelmed by the range of investment choice. That can become quite overwhelming. So what would be a great place to start for those types of investors who just want a one-stop solution to meet their investment needs and to grow their capital base would be to consider one of our balanced fund offerings, which are either offered in a sort of more moderate aggressive framework or more conservative framework, just depending on what your risk appetite is. And within those balanced funds, Satrix does all of the hard work and the heavy lifting of deciding which asset classes to track, what investment strategies to utilize, what the weights and combinations of those should be to deliver an appropriate outcome for to meet that risk profile of different clients. But what often happens then is that investors, as they progress through their career and their the wealth accumulation phase of their lives, what typically happens is that their financial affairs start becoming increasingly complicated. And hopefully they've also built up a bigger capital base. So this then becomes an opportune moment to involve a financial advisor to optimally structure your affairs and to provide for yourself and for your dependents, and to ensure that you're on track to meet your financial goals. So I think that outlines some of the ways that investors should think about whether they need financial advice or whether it's the appropriate time for financial advice. There's definitely a role for it. It can play a hugely valuable role in making sure that your affairs financially are structured optimally.
Thanks, Kingsley. And that's always a good problem to have, is a complicated financial structure, isn't it? But before we continue, let's give you, our expert audience, again, a chance to weigh in on your use of thematic investment vehicles. Please make the selection on screen. You'll see a question poll emerge again. So are you and your clients investing thematically? If so, how have you integrated thematics? Choose one of the options, please. So while we await the results to come in, I am going to invite our next expert panelist, Rob Powell, to join us on the proverbial stage. Now, Rob is the head of thematic and sector product strategy at BlackRock, hence the question to precede his discussion. So I want to welcome you, Rob. Thanks for your time today.
Hi, Nico. Thank you very much for having me on the call today.
So our participants are applying their minds very carefully. So I can see it's about half have already responded. So hopefully that will pick up quickly. It's not a trick question. Are you considering or have you considered implementing thematics in your investment portfolio? So as the results trickle in, I can, well, let me give you one more 20 seconds, let's say. Okay, so let me, I think that's a sufficient number. Let me end the poll there. So, Rob, about, what's that, 73% are saying no, not planning, or no, but considering. So you do have some work to do in terms of convincing our audience that thematics and global megatrends is something to consider as part of their portfolio. So no pressure there, Rob. Rob, thank you, welcome, and thanks for your time. So given what has been discussed so far, and you know what Laura said and what I mentioned in the introduction, has any of the prevailing market conditions and geopolitical tensions changed your views at BlackRock at all on the global megatrend opportunities that you have identified in the past?
Yeah, thanks, Nico. Hopefully we can change the view of some of those people who said they might not be considering implementing thematics into their portfolio. So in terms of how the last few years have changed our views on the megatrends, you know, it's obviously been a very challenging period for investors since 2019, really, when you had the COVID pandemic, which altered how we do things, all elements of our lives. Global populations went into lockdown, then were released from lockdown, and we've had some permanent behavioral change that has happened as a result of that. And then this year, we've seen a huge focus on the rotation within markets, the focus changing from growth to value in investors' minds as being an interesting investment concept, which has been further exacerbated by the conflict in Russia-Ukraine. And, you know, we talk a lot about these long-term megatrends that we've written some research on that really formalize BlackRock's view on what the most important long-term drivers of change in the world are. So these megatrends really represent what we feel are going to be changing all of our lives, from how we work and play to you know, everything that we're doing. So when you're looking long-term, you can't just set some views and then forget about them. You have to constantly review. And so we're doing this on an annual basis, at least, when it comes to these 5 key megatrends. We originally wrote the research into these in 2016, and we've gone through the process of reviewing them annually, as I said. The biggest debate through the COVID period related to urbanization as a megatrend. So the urbanization megatrend refers to the fact that we are seeing mass migration of the global population living in rural areas to living in urban areas. And we had hefty debate, as you can imagine, through COVID, as we all started working virtually and doing more and more things virtually, as to whether the pull of living in urban areas was still present. And where we've landed is that, yes, it is. And I think in developed markets in particular, the global view is somewhat shrouded because we see colleagues and friends moving out of urban areas to benefit from increased flexibility by doing things like this virtually. But in less developed markets, we're seeing better healthcare outcomes, more work opportunities, and better standards of living in general in urban areas that are continuing to pull people from the rural areas to the cities. So we expect that to continue, and particularly in some of the emerging markets in Asia, this is going to be an increasingly important driver of change in the world. If we come closer to today and think about what's been driving markets and changes in our portfolios, the biggest change or the biggest development in how we've been thinking about the megatrends is the increased focus on climate change and resource scarcity. I think historically we've focused on technology as an enabler of all of the other trends, and that's not going away. But what has happened over the last couple of years is this increased focus on the climate emergency. We're seeing a massive uptick in the number of climate disasters that are happening across the world. The profile of the state of the climate is, has been raised quite significantly over the last couple of years. And, we are talking as COP27 is going on, and this continues to solidify demand and interest in climate change. So when it comes to thinking about how we would rank our megatrends in terms of their importance, we've certainly promoted climate change over the last couple of years to be the trend that is driving change in the world, and will be for the next few years, we expect.
So, Rob, can you share some thoughts on how, practically speaking, investors can capture these unfolding megatrends in their portfolios that you mentioned?
Sure. It should be said that one of the biggest challenges when thinking about megatrends and long-term themes is coherently constructing portfolios that properly reflect the disruption that they are driving. So at BlackRock, we focus hugely on the research behind the investment opportunities that enable us to provide exposure to these kind of themes in portfolios. If you think about a theme like climate change and resource scarcity, because of the far-reaching effects that megatrend is having a portfolio focused on that whole trend would end up doing something that wouldn't necessarily add a huge amount of value in a portfolio context. It would potentially be over-diversified, and it wouldn't be differentiated enough from the core holdings in clients' portfolios. So what we try and focus on is whether there's a problem to solve or whether there's momentum to harness behind one of these megatrends. So think about translating the megatrend into an opportunity set that is narrower and more implementable. So one of the biggest challenges relating to climate change is global temperature rises. And one of the biggest contributors to global temperature rises is the power sector. So a focus on renewable power, alternatives to traditional fossil fuel energy sources, and companies that are providing those can be beneficiaries of the regulation and consumer focus on climate change. We're hearing from consumers that they're prepared to pay more for sustainable alternatives, and this is a big change, which is driving opportunities for companies that are providing solutions for these problems that the long-term megatrend is presenting. So it's all about being more specific, focusing on problem solvers and momentum drivers, and looking to harness those in a portfolio context.
Thanks. And then lastly, where have you seen the most interest in your thematic funds, and specifically on investors taking a longer term view when using these funds as building blocks?
So as I said before, I think, despite these investment products being focused on long-term trends and megatrends playing out over many years, it's important to have a short-term context when thinking about these kind of investments. The biggest change this year when it comes to demand for thematic products has been driven by the unfortunate conflict in Russia-Ukraine, which has put extra emphasis, as I said previously, on some of these trends that have been playing out for a long time. So If you think about climate change, which we've already discussed, the COP meetings and global policy has put 2050 as the arbitrary timeline by which we need to reduce global temperatures. So a long way out, but we've recognized for a while that investments in this area are needed. What we've seen over the last 10 months or so since February is that policymakers across the world are looking to focus on energy independence, reducing their reliance on Russian hydrocarbons. And we've seen trends and themes that focus on that area being beneficiaries of this, as well as the investments in energy independence. We've also seen a huge amount of regulation that is coming through focused on green infrastructure. So many people will have heard of the Inflation Reduction Act in the US and the European Green Deal, stimulus packages that are focused on green infrastructure, which are putting unprecedented amounts of government funds towards these kind of sustainable infrastructure projects, which are going to enable the world to decarbonize and move towards these temperature targets. So what we've really seen developing within the thematic space is almost a barbell between some growthier areas within the industry focused on sustainability, so renewables, green infrastructure in particular. And then on the other hand, we've seen some inflation beneficiaries coming through. Laura mentioned this earlier on the call, that we've seen certain areas of the market being seen as inflation beneficiaries, being rewarded by investors, and that's been the case within the thematic investing space as well. So we've seen agricultural companies come to the fore in this environment, as we've seen supply tightness coming through, and other themes that are inflation beneficiaries, such as water exposures. So very much a barbell emerging between some resilient areas within growthier themes and also some inflation beneficiaries.
Thanks, Rob. So, Kingsley, if I can turn the attention back to you. So Rob has taken us through BlackRock's motivation for including thematic investment funds as part of a well-balanced portfolio, offering unique sources of return and diversification. Now, can you give us some insight into Satrix's range of thematic investment funds available to local clients?
Yeah, sure, Nicky, thanks. I will share a slide again just to support what I'm saying. So hopefully that is coming through again. These are the range of thematic funds that we offer and the indices that they track. So NASDAQ 100, China, India, infrastructure, smart city infrastructure, healthcare innovation. We've got 2 ESG climate transition benchmark indices that provide exposure to developed markets and emerging markets. And then we've got a locally focused inclusion and diversity ETF. But looking at this list of thematic funds doesn't really help an investor understand the context within which those were created and what they provide exposure to. And this is where our relationship with BlackRock in understanding the megatrends and the excellent work that they've done in putting that megatrend framework really comes to the fore. So just to reiterate what those megatrends are, those are going along the top here. So shifting economic power, which speaks to the shift from west to east, demographics and social change. That one's quite self-explanatory. It speaks a lot about aging populations and the impact that will have as well. Technological innovation and breakthrough, rapid urbanization, which Rob referred to earlier, and also climate change and resource scarcity, which was another key megatrend that Rob touched on. So once you have that framework of the megatrends, it then becomes quite easy to think about how these thematic funds, which have specifically been designed to capture and provide exposure to these megatrends, fit together. And that's really what this slide aims to capture. Nico, I think you put it best once when you said the way to think about thematic funds is that they are the yachts or the ships sailing and harnessing the megatrend currents and forces that are shaping our world. So I think this will hopefully give investors some context around how the different thematic funds can be used and what megatrends they offer exposure to.
Well, many investors might argue that they can access these vehicles directly through iShares. Can you comment on why both retail and institutional investors might find these Satrix feeder ETFs that feed into iShares as thematic investment funds? Why might they find that compelling as opposed to going the direct route?
Yeah, it is a question we often get, and it is the case that the iShares ETFs in and of their own would be more cost effective than the Satrix ETFs which feed into them. But investors, particularly in South Africa, have a number of hoops they need to jump through before they are able to invest in iShares directly. And these would include opening an offshore platform account, actually converting your rands into foreign currency to be able to trade in those hard currencies, and then factoring in the tax and estate implications of having offshore domiciled assets in your own name are just some of the considerations and costs that need to be given consideration to. All of those things require costs and administration overheads, which do need to be considered. So, yes, while the iShares may be more cost effective directly, the total cost of access could be higher for a South African investor once they've gone through all of those hoops, and probably a lot less convenient than what is available locally, which can be accessed, as I mentioned earlier, very easily through a variety of platforms in the South African context.
And then also in a recent interview, you mentioned that feeder ETFs, specifically these Satrix feeder ETFs that you mentioned that trade on the local exchange, that they offer returns close to or even above their benchmark. Now, I want you to pause at home quickly and think about that. So can you clarify this statement, as it might sound confusing at first, that after fees and after costs, an ETF can actually outperform the benchmark that it tracks?
In certain cases, yes, that can indeed happen. And it all has to do with the tax efficiencies of the ETFs we feed into, which are able to unlock lower dividend withholding tax rates than a traditional collective investment scheme would typically have access to. So the convention globally is to report performance against a net of withholding tax total return index. And what that index does is it assumes a withholding tax rate that applies for each of the countries that you're investing in. Now, to the extent that a fund or an ETF is able to access a lower withholding tax rate, that would be one of the ways in which a global ETF can outperform its benchmark or deliver performance in line with the benchmark on a net of fees basis. And we certainly see that to be the case with some of the ETFs that we provide on our platform, which feed into the iShares.
So the beauty of that is that these thematic feeder ETFs that you include in your portfolio can actually improve the sophistication of your portfolio quite easily and cost effectively, and also has some tax benefits. So definitely something to consider. And hopefully, if we take that poll that we did earlier now, there's quite a few more of you that might actually consider including thematics in their portfolio. Thanks, Kingsley. Next, I want to ask Laura to again just join us. So, Laura, COP27, the Global Climate Conference that finishes tomorrow. What are your thoughts on this year's conference? A lot of people are saying it's a lot of greenwashing, and others are more optimistic, saying, that we're sort of at last chance saloon when it comes to dealing with climate challenges. Were there any key announcements or takeaways that you could have that you picked up that might have implications for financial markets specifically?
Well, it's a great question. And I think the way you framed the question kind of captures the mixed expectations heading into this year's event, largely because we have seen high expectations ahead of previous events, only to be met with disappointing outcomes. So I think ultimately there were key challenges facing this year's event. The most notable was something that Rob alluded to, in the sense that time is running out to achieve key targets of net zero by 2050. We had the UN already flagged that there isn't really an achievable plan out there to limit the climate raise to 1.5 degrees centigrade by that time period without significant global changes. So I think it was a high bar already for any kind of practical solutions out of this year's event. That being said, there were probably two key questions that I was watching for in this latest iteration. So the first is addressing the challenges faced by EM as they try to grow their economies amid this decarbonization trend. And then second, taking a step back and asking, what role do investors play in this transition away from carbon-driven economies? So I think overall the tone has been quite optimistic, but again, there are clear that challenges still remain. So probably four key takeaways with market implications at this stage. So the first is emerging markets. Now, as you mentioned at the beginning on the poll, investors are starting to look at emerging market equities once again, and we are seeing that across our business as well. Investors are increasingly allocating to equities, and Brazil is actually amongst the highest conviction views that we hold within EM. So we did have the newly elected president vow to make the country a leader against climate change, cracking down on illegal deforestation, which is quite notable when Brazil is home to about 60% of the Amazon rainforest. So it could be a leader within the EM space on this front. Second, US-China tensions appear to be thawing at the margin. There has been an agreement between the two leaders to resume cooperation of climate change. And I think this is quite notable given that these are the two biggest emitters. So it is a key signal to the rest of the world that they are committed, at least in name, to continue on achieving this progress. Third, the European Union did raise its target for cutting greenhouse gas emissions. It updated its pledge to cut emissions by 57% by 2030. And that really aligns with our view that the events over the past 2 years have accelerated this transition to renewables. So we do expect investments in the future of transport, clean energy to continue to be strong beneficiaries of this. And in fact, by 2035, all new cars in the EU will need to be zero emissions. So this is a clear tailwind for this investment shift. And then finally, the overarching theme of how to limit global warming to the 1.5 degrees Celsius above those pre-industrial levels. It was a key theme of last year's event, but this time I think we're struggling to see signs that that is actually going to be achievable. So the US and the EU have both said that any final agreement should underscore the importance of this objective, but other nations have really resisted reaffirming this goal. There's a Bloomberg report out this morning suggesting as much. And so the challenge is that the planet has already warmed by about 1.5 degrees Celsius compared with pre-industrial levels. And under the current policies of national governments, the world is expected to heat up to about 2.1 to 2.9 degrees Celsius this century. That was based on the latest UN report. So it's clear that there is much more progress to be made on this front. So the key implications for markets on this last standout point is that this transition to low carbon technologies like wind turbines, solar panels, hydrogen fuels, electric vehicles, electric heat pumps, all of these could see further acceleration in those kind of thematic type of structural trends. So these measures alone are projected to help the US cut its emissions by 40% below 2005 levels by 2030. So it really underscores the importance of the US kind of committing to these objectives. And I think it underscores the need for investors to have allocations to these bigger thematic type of trends that are going to play out over the next decade or so.
Fascinating. And Rob, if I can return to you one last time. So Laura mentioned the impact that a lot of these discussions are having on thematic trends and how that plays out. What do you see as key impacts of COP27 on megatrends or thematic investments more broadly? Are there any new thematic investment opportunities emerging as a result of these talks?
Yeah, so I think as thematic investors, we're obviously keenly watching what happens at COP, especially given the focus on climate change and how much importance we're putting on that as a long-term driver of change in the world right now. So the first important consideration or takeaway from the COP meetings is that this really is going to solidify demand for climate-related themes and for investments that can deal with the problems that climate change presents, such as those that I spoke about before. So think green infrastructure, think renewable power. The second thing to note is that, and this is something that we've been thinking about for a while through our thematic think tank at BlackRock, is that there's been a real acceleration in climate change policy over the last few years, particularly focused on emissions, so trying to keep global temperatures down. And I mentioned this before. What is being considered less is the effects of those policies on the global population. So we are monitoring the social aspects of climate change, and we think that the focus on carbon transition is likely to develop over the next few years to being today focused on getting those temperatures down, to in future focusing on getting those temperatures down and not contributing to increasing inequality in the world, because unfortunately some of the policy that's coming out, as I said previously, is disproportionately affecting some of the poorest people in the world. So we see opportunities for social related themes going forwards, driven by a lot of this climate change policy. So that's the second consideration. And then finally, through client conversations that I'm having across the world, something that is coming up very frequently in climate related discussions is what's next? Where are the investment opportunities going to be with regard to climate investing? And obviously this has been a challenging year for some of the investments that are perceived to be clean already. We've seen, as Laura spoke about at the start, energy being one of the best performing, if not the best performing sector in global equity markets this year. And that's traditional energy, by the way. So many of our clients are asking us how we can invest in companies that are transitioning, that are on a path to net zero, rather than those companies that are already displaying very positive ESG or sustainability characteristics. So we're working on exposures and thematic investments into companies that are on that path and are on that path faster than their peers, because we think that companies that can deliver carbon reductions are going to make a tangible impact on the global economy and the transition to net zero. Three key considerations: solidification of demand for climate-related themes, effects of policy, looking at social aspects, and then also thinking about net zero transition and how we can invest in companies that are going to be rewarded by being on that path.
Amazing, thanks. I just want to remind our audience that if you look at the Q&A button at the bottom, you can just ask a question. I see a few questions coming in, and if I can pose one to you quickly, Rob, it is connected to a lot of what you were saying. As one of our attendees are asking, what will happen with companies that are dependent on carbon resources? Is there going to be disinvestments or red flags? And I think this is a very particular question, or a very relevant question to us, because a lot of people are saying, well, if you apply strict exclusions to carbon companies, how does that affect the social side of sustainability? In other words, people losing their jobs, their livelihoods. How does this play out? Do you have any specific thoughts on that?
Yeah, so I think that there's an increasing realization in the investment community and the global population that we need resources to be able to transition. Over the last few years, there's been huge focus on companies that are already green and have low carbon emissions already. You think about the last 50 to 100 years of economic development, it's largely been driven by fossil fuels, whether that's in how we power our economies, how industry works, even in the field of fashion. We obviously know that's not sustainable because of the carbon emissions that are playing out, and that's contributing devastatingly to global temperature rises. We would argue that the next 50 years of economic development can be driven by metals. We need copper for solar power plants. We need aluminium, steel for wind turbines. We need lithium and other materials to go in the batteries in electric vehicles, all metals. So we expect to see this shift and this increasing recognition that we need these resources companies, and that it's important to work with these resources companies to enable them to transition and reduce their own carbon emissions. So I think that's a slightly nuanced change in how the world is thinking about sustainability, but one that's absolutely required given the direction of travel.
It's absolutely true. I think for climate discussions and sustainability discussions to be relevant, it needs to be pragmatic. We need to keep in mind these challenges that we're facing, is that pure exclusion is really not an option. We need to be pragmatic about how we deal with these companies and work with them, right? Work with the companies that are polluters or have certain challenges, and understand how to best bridge these challenges. You touched on lithium, and that's also one of the questions that is asked about, whether there's specific vehicles that actually track this. And I do encourage you to also look at BlackRock's range of thematic investment vehicles, which is quite broad. If I can quickly just pass the ball back to Kingsley. Practically speaking, Kingsley, how can index tracking investment houses like Satrix incorporate sustainability into their portfolio construction, specifically when they have a mandate of tracking an index? Can you simply exclude a stock or a sector?
Yeah, Nico, I'll try and be brief with my response, but index trackers have, such as ourselves, have a vital role to play in ensuring that companies included in various indices are sustainable businesses. And when I say sustainable, I mean that in the broadest sense, and that they're sustainable over the long term and have concrete plans in place to address the numerous risks and threats they face, including the climate risks and the implications that may have on their future business models. So while for the most part, index investment managers are not, don't have a mandate to be able to vote with our feet by not holding certain companies in the portfolio, we are certainly able to vote with our presence in the sense of being able to vote on those proxy votes, at the general meetings on key issues affecting the sustainability of those businesses, and then also to engage with those companies separately to try and drive change proactively and in a constructive way. So this is all known as stewardship or active ownership. And as index investment managers, we are long-term holders of essentially the investable universe, the listed investable universe. And that puts an increased onus and responsibility on index investment managers on the crucial role they can play and must play in ensuring the long-term sustainability of the companies and markets in which we invest. So I think at a high level, that's the role we can play. But below that, there are obviously strategies that can be brought to market in a rules-based framework that cater for investors who want to take a stronger stance, where they don't want to hold certain companies in their portfolio. They want a better ESG profile. They want to be minimizing carbon intensity or emissions, or making a positive impact on social dimensions. And the beauty of tracking indices that are designed along those dimensions is that you get the same transparency and consistency that you would get with any other rules-based or systematic investment strategy encapsulated in an index, in that you know exactly what you're going to get, and that provides investors with the confidence to utilize those investment strategies within their portfolio, knowing that they're going to consistently achieve a particular outcome within those strategies. So I think, just in the interest of time, we've obviously got two broad market global ETFs, which specifically do exclude companies with controversies and maximize the ESG score and limit carbon emissions and are compliant or exceed the requirements laid out for the EU climate transition benchmark. So those products are available and accessible on the JSE. And then there are other thematic funds which also incorporate sustainability and ESG criteria, such as the healthcare innovation and the healthcare innovation and the smart city infrastructure ETFs, which we also provide. So, I think just to wrap up, with all of the data available in the sustainability domain, there are literally an infinite number of ways in which sustainability objectives can be incorporated into an index or a rules-based or systematic strategy. So for our investors that are listening today, if you do have specific sustainability requirements that you're trying to solve for, please do reach out to us. We do have all of those data sets and tools available to be able to work with you to try and solve your specific requirements.
Thank you so much, Kingsley. And to all of our expert panelists, thank you for your wonderful insights. And as always, thank you for attending. You've earned yourself a CPD point, and 2022 is almost over. We're almost heading into December. So Yes, I thank you for your attendance. I thank you for our wonderful panelists for their insights. We will see you again. Goodbye.